Good morning, options traders, and happy Monday. I hope everybody had a great weekend. And in the last video, I talked a little bit about what is a futures contract. And the idea is to show everybody how to get an indication of where the markets will open. Because I typically post in here, based on the futures contracts, it looks like the Dow is going to open up down 500 points or something to that effect. Well, how am I getting this information? Well, it's ultimately based off of the futures contracts, but even for traders who understand that, they usually make a big mistake and look at the wrong numbers. You don't want to just look at the futures closing price, you have to look at the fair value. So that's what we want to talk about in this video. What is the S&P 500 futures fair value? So first of all, understand that every single financial asset has what's called a fair value. It's just a mathematical calculation that says this is what you should pay for this asset, or what you should receive if you're selling it. It's a price that doesn't favor the buyer, it doesn't favor the seller, it's fair to both parties. So futures contracts have a fair value, options have a fair value, treasury bills have a fair value. They all have different calculations, but the concept is the same. When it comes to the S&P 500, the futures contracts usually trade at what's called the cost of carry minus the dividends. So to make the example easy, let's say that the index is trading for a nice round number of 1,000. Let's also assume that the interest rates are 12%. I know they're nowhere near that, but I'm doing this to make it a nice round number of 1% per month, again to make the calculations easy. Well, based on this information, a 3-month futures contract should trade for $1,003. That's because the cost of carry is 1% per month. Now let's also say that the S&P 500 pays out 1% in dividends. Well, if somebody buys all of the stocks in the S&P 500 and sells this futures contract, they're going to collect those dividends. So it's now going to reduce this fair value. So let's say if they collect 1% in dividends. So because of that, this 3-month contract would actually trade for $1,002. And so we would say that this is the contract's fair value, 1,002. And so in the open market, it would trade for no more and no less. Kind of strange when you think that it seems like the futures contract should be able to go off in its own sets of supply and demand and trade at anything. But it's actually locked. It's joined at the hip with the actual underlying. And you might say, well, that sounds a little odd. How is that possible? Well, the answer is arbitrage. Arbitrage is this idea of capturing a risk-free profit. And you could do that if the futures value traded for more or less. So let's say that the fair value that we just calculated is 1,002. But for some reason in the open market, the contract's trading for 1,003, trading for a price more than fair value. Well, what would happen is that traders, actually nowadays it would be by computers, but the idea is the same. They would go out there and they would sell this contract. Why? Because it's relatively expensive and they want to sell the higher priced item. Then they could borrow money and buy an equivalent number of shares in the open market. So they're going to buy all 500 tickers, actually about 504 tickers, but they're buying all of the underlying stocks in the S&P 500 in their exact proportions. That's why it needs a computer to do this, but it's done instantly. And when they do that, they've now locked up the shares to make delivery on the contract, and that results in a risk-free profit because they've bought them cheaper than what they're worth, and they've guaranteed the sale at 1,003. Because remember, a futures contract is not the right, it's an obligation. So by selling this futures contract, they know for a fact they're going to receive $1,003 for that sale. But notice what these actions do. It increases the share prices in the open markets because they are buying these shares. They're going up and buying all of these underlying stocks. And it also decreases the futures prices because they are selling the futures contracts. So the futures contract's getting hit with a lot of sell orders. The shares are getting hit with a lot of buy orders. And so what that does is it tends to bring these prices back in line until the futures contract is right back to our magic number of 1,002. And if it's not, arbitrage continues and risk-free profits are the incentive. So we know it's going to take place. Well, what's going to happen if the futures price is less than our fair value of 1,002? Let's say the futures contract is trading for 1,001. Well, the traders or the computer programs will just do the reverse. They're going to buy the contract because it's now relatively cheap, and they will sell the equivalent shares in the exact proportions in the open market. And with all of this money they collect, they will invest that in the risk-free money market. And again, this generates a risk-free profit. But once again, notice what their actions do. It decreases the share prices in the open market. Why? Because they're hitting the markets with a lot of sell orders. But it also increases the futures price because they're hitting the futures contracts with a lot of buy orders. And that will continue until this price right here at 1,001 jumps right back up there to 1,002. We will see that futures contract very quickly, within a matter of seconds, go right back to 1,002. So again, this is why I say that they're kind of joined at the hip. We see the index as one thing, we see the futures as another, but there's a mathematical connection that keeps them moving by this distance of the cost of carry less dividends. So now that you know the basics, let's take a look at how we would do it for the S&P 500. So again, the cash market, the actual index, closed on Friday at 2830.71. Interest rates, pretty close to 0%. The S&P dividend yield is about 2.1%. This is a little bit of the wild card because it depends on which time frame you measure this over as to what percentage you're going to get, but it's somewhere around 2.1%. There are 45 days to expiration with the June futures contract. So how many dividend points is that? Well, I'm going to take 2.1% times 2830.71. That's going to give me the percentage of that value right there. But then I'm going to multiply it by 45 days over 360. And so that tells me it's worth about 7.4 points. So the fair value would be the 2830.71 times 1 plus the interest rate times the time to expiration minus the 7.4 dividend points. Well, this part right here is 0. So this whole thing just boils down to 2830.71 minus 7.4, and that means the S&P's fair value as of Friday was about 2823 and change, somewhere in that range. So if you look at CNBC's website, it showed that the index close right there was 2830.71. The futures at that moment were trading for 2803.25, down about 18.5. This is what most traders look at right here to say, oh, the markets are going to be down. Not necessarily true. And the reason is you're comparing the futures contract to the actual closing price. And what should you be comparing it to? The fair value. And that's why they show you this down here. So the fair value, pretty close to what we calculated, right around 2823. Current futures, notice these numbers are the same. And they're saying they're down about 19.5. So in this case, not a big difference. 18.5, 19.5, yeah, kind of giving you the same, what's called the implied opening. But that won't always be true. Sometimes there are drastic differences between these. And to understand that, we have to wait for the third video. But for right now, the one thing I want you to understand is that if you're trying to get an idea of where the markets are going to open, do not look at the current futures price compared to where it closed. You have to look at the current futures price compared to fair value. So remember, when you're reading your futures, trying to get a handle on the market, don't compare the futures price to the last trade. Always compare the futures price to fair value, and that's going to give you your best estimate. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.